Welcome back to the Personal Finance Project. Up to this point, our podcast has focused on general financial planning topics. As most of you know, the majority of our client base retired from ExxonMobil. We recently launched the podcast to our client base and been overwhelmed with the positive feedback that we've received. In order to serve our clients who are preparing to retire from ExxonMobil better, we are going to begin quarterly updates on the segment rates. If you are preparing to retire from ExxonMobil, you've most likely heard your colleagues discussing the segment rates and their impact on the lump sum pension. So, Scott, to kick us off, tell us about how the ExxonMobil pension plan works.
Yeah, so I think to start, I would say that let's start at the very beginning. The pension plan is what's called a defined benefit plan. This is a little bit unique nowadays. If you go back to maybe the 50s, 60s, 70s, a lot of big companies had these defined benefit plans where the employee was not making contributions, but the company was setting money aside with, as the plan description would have you know, there's a specific dollar amount that they were guaranteeing you sometime in the future. This is based on your years of service, what you've put into the plan, or excuse me, not what they've put into the plan, and then a growth rate that was based usually on bond returns as opposed to the market. This is different from a defined contribution plan, which is a lot more popular now, where this is your 401k or your 403b type plan, where the employee is putting money into it and the employer may provide something like a match or profit sharing into that plan, but they're not guaranteeing that it's going to be worth a certain amount sometime in the future. So this is a defined benefit plan where they are going to look at a combination of your years of service, how much you've earned while you worked at the company, and your age to determine basically an annuity amount, where if you were to take the pension in the form of a monthly payment, how much is that going to be worth? So what happens then, as you're talking about the segment rates, is the most common way that people take the ExxonMobil pension, at least in the last 15 years or so, has been the lump sum. There's a few reasons for that, but especially from, say, 2008 to 2020, people tended to take the lump sum because interest rates were very low, which caused the lump sum calculation to be very high because the lump sum value is inversely correlated with interest rates. So that's kind of a general backdrop on how the plan works. It's a combination of your age, how long you've worked there, how much money you made, and there's a lot of other stuff going on behind the scenes.
So, in speaking of the segment rates, could you tell us a little bit about what they're tied to and what they mean?
Yes. So the segment rates, the segment that it's referring to is the number of years that are being used for that part of your pension calculation. So the first segment is for the years that are for years 1 through 5 of your future cash flow distribution. Because what's happening when we get the lump sum value is they're taking the value of the annuity payments over the rest of your life, they're discounting them based on these segment rates into a lump sum today or a present value. So the first segment is for discounting the payments you'll receive in years 1 through 5. The second segment is for years 6 through 20. And then the final segment, the third segment, is for years 21 and beyond. Because of the fact that the second segment, one, is closer in time to the third than the years that are going to be applied to the third segment, and also because it's just so many years, it's 15 years as opposed to 5 for the first segment, that is the one that if you're really just going to try to, summarize this down to one number, how is the second segment moving? And that will give you an idea of where your lump sum is probably going to be going.
Okay. And outside of the discount rates, are there reasons why someone might work slightly longer or even leave slightly sooner?
Yeah, there are. There's other factors. So a couple of requirements to get a retirement distribution from the pension, which basically is what's going to give you the ability to take a lump sum. say you work at ExxonMobil or another company that has a defined benefit plan for 10 or 12 years, you're probably vested in the plan, but you may not be able to take a final retirement distribution in the form of a lump sum. So in the Exxon plan, you need to work there for 15 years. So that might be a reason that, say, the discount rates are very low and you're retirement age, but you haven't worked at Exxon for 15 years. That might be a reason to keep going so that you can take a true retirement distribution. Another reason is that you are eligible to take the pension at 55 if you have 15 years of service, but your the full benefit or the kind of the planned benefit commencement date for the plan is 60. So if you initiate at 55, you're going to receive 75% of the amount you would receive at 60. So basically, every year that you continue to work or defer taking the pension from 55 to 60, you get 5% more. So in a period like we're in right now, what we're seeing a lot of people do is retire, say at 56, if that was their plan, but not initiate the pension lump sum right away because they're thinking, okay, for the next 4 years, I'm going to get a 5% rate of return on waiting to the full retirement age for the plan. And if interest rates decline over the next 4 years, which I'm not making a grand prediction on, but they're cyclically on the higher side right now. So I think it's possible if you get a combination of waiting a little bit into the full retirement age of the plan and then also getting a decline in interest rates, that's where you could get, maybe a big 12, 14, 15% increase in your lump sum value.
So this is a question that just occurred to me, but say someone does make that decision to retire at 56 but not initiate their lump sum until they're 60. Is that something that you would meet with a client about to talk about where they're going to draw their income from in those 4 years?
Yes. So that is actually a huge consideration for, whether you take the lump sum or the annuity, because say you're retiring at 55 and you don't have a lot of after-tax, say emergency funds or savings. It's beyond an emergency fund at that point. We're talking about 5 years of living expenses, basically. So if you need coverage for those years between 55 and 59 and a half, which is when you have the ability to take money out of your IRA or your 401k, that could be a strong consideration in how you handle the lump sum versus annuity decision. The other thing, and I think we should probably do another episode on this in the future, is that one thing that a lot of people, specifically at Exxon, are able to do to bridge that gap between 55 and 59 and a half is take a net unrealized appreciation distribution from their 401k. What that allows you to do is go into the plan and take out very low cost basis shares, pay tax at your historical basis, and get them out of that environment where you have to wait until you're 59 and a half. So sometimes people don't have a whole lot of money outside of the plans, but can still retire early because there's enough low basis stock to cover them from 55 to 59 and a half.
Yeah, I think that would definitely be worth another episode.
I think
for
it
sure.
probably would be. One last thing that I wanted to mention is that another factor in the plan is that really what we're kind of talking about today, I would call the qualified pension, which is the amount that there's a specific income number up to which point Exxon or another company is going to make contributions to the qualified portion of the plan, which is eligible for rollover, and which the company is required to offer a spousal continuation on the annuity payments. So a lot of times what people will do is if you're going to take the annuity, you don't necessarily want it to go away if you pass away early. So if you're married, you select an option where 50% or even 100% of that monthly benefit is going to go to your spouse if you were to pass away. Another point, beyond that level of compensation, which it used to be about $260,000, but I believe it's been indexed a little bit higher than that, is you can qualify for a supplemental pension or an additional payments plan pension payout. These are different in that one, they will only be paid as a lump sum. There's no option to take them as an annuity. And as, pardon me, they are not eligible to roll over. So you will pay tax on them at the time that they are paid out. So that actually, going back to your other question, are there reasons why you might change the timing of these distributions even if the interest rates aren't moving in your favor? If you have a significant supplemental pension plan or additional payments plan, you might want to retire in January so that that taxable income is not stacking on top of an entire year's worth of compensation. So if you're in that executive comp level where you've got the additional payments, the supplemental pension, restricted stock vesting, there's a couple other things that come into play.
And I know you've kind of already begun to touch on this, but if someone does take the lump sum, does that impact, I mean, as you mentioned, it does impact their income in the year of retirement. But do you want to expand on that?
Yeah, so for the qualified portion of the pension, if you take a lump sum and roll it over to an IRA, or you actually can have it paid to the the Voya 401k plan if you want to. If you do that, there is no taxation in the year of the lump sum. For the additional payments and the supplemental, those, like you just alluded to, those are taxable. There's no deferral option. There's no annuity option. So it's going to be taxable income in the year of retirement.
Okay, that makes sense. And so, again, this is kind of a similar question, but what are the tax implications of the lump sum?
The non-qualified portion?
Yes.
Okay. So the non-qualified portion, what's going to happen is Exxon is going to tax it and withhold taxes on your behalf. So I'm going to just use an imaginary number here. Say you have a $500,000 supplemental payment pension. What's going to happen is they're going to withhold approximately 25%. So something like $125,000 will be taxable income, but sent directly to the IRS on your behalf. At the end of the year, you'll get a 1099-R, which shows that you got this payment and that some taxes were withheld on your behalf. The remainder of that money, in this example, $375,000, it is taxed, but you need to understand that if you got a qualified pension, or excuse me, a non-qualified pension payout of that magnitude, you're probably going to owe more than what they withheld. So you might need to think about, all right, of this money, I probably need to hold out another $75,000 to cover the rest of the tax to get me up to, say, a 35% rate, something like that.
Mm-hmm. And I know you've touched on some of these reasons already, but just to kind of continue to explain reasons why someone would take the lump sum over the annuity or vice versa.
Yeah, so like I mentioned a little bit earlier, when interest rates across the board are very, very low, it's hard to make an argument for the annuity. And the reason for that is that you're getting paid so much extra to take the lump sum. Because if you think about it, what these interest rates really doing are they're telling ExxonMobil and the pension plan, okay, these are the rates that we're expecting to get on this money while we pay you an annuity for the rest of your life. So what the company is doing is saying, gosh, interest rates are super low. It's going to be difficult for us. We're not going to earn much on this money. So in a way, even though we're going to have to pay you more today, I would argue that these plans probably like it when you're taking the lump sum when interest rates are super low, because it takes that liability off of their balance sheet, so to speak. They know they're not going to have to pay a lifetime of income when interest rates are super low. So if you were to, take the annuity when interest rates are low and then they start to go up and inflation starts to get going again, you're in a little bit of a difficult situation because the annuity pension is not going to get a inflation adjustment. So say you retire and rates are very low and inflation is very low, and then all of a sudden it's 2022 and inflation's running at 7, 8, maybe 9%, you're losing a lot of value to to inflation over time.
So, kind of interest rates aside, are there behavioral reasons that you might suggest someone take the annuity over the lump sum?
Yeah, I'd say there's two that I can think of. One is I think you could say this is behavioral, but tax control. Because if you take the annuity, you're basically signing up for a specific amount of income each year into the future. We also know that if you work for these big companies, you are going to qualify for Social Security. Your spouse may also qualify for a spousal or their own Social Security benefits. So you're kind of opting in to a certain level of income each year. If as a behavioral idea, you want to do something like Roth conversions or charitable gifts of a certain magnitude, it might make sense to not sign up for that significant level of income that you can't defer, you can't turn off, you can't opt out of in the future. The second one that I can think of, and I'm trying to think of the most polite way to say this, is that if you recognize that you sometimes have spending discipline issues or budgeting problems, say you plan to spend $8,000 a month, but you find that you just always manage to spend 12. The annuity might be a good choice because the downside to the lump sum is, as the name would imply, it's a lump sum of money, and then if you run out, Exxon's not coming to save you. You know, this is going to have to cover the rest of your life. So if you can be a little bit introspective and realize that maybe you have some spending discipline issues, or you just have a lot of obligations, you know, say you've got kids that you're supporting, or you got started with a family a little later and you've got a lot of college costs, things like that. Maybe the annuity makes more sense because you know you can't outlive it, and it could prevent you from overspending to some degree.
And I know with our client base that's a rare scenario.
It is.
But when it comes to taking the lump sum, in your unbiased opinion, what is the importance of good planning if you do take the lump sum?
Yeah, I think if you take the lump sum, what you need to do is ensure that in addition to that lump sum, you know, what you're giving up is an stream of income that you literally cannot outlive. It will go for the rest of your life. So what you need to do is look at that lump sum number plus anything else that you have. Let's say the 401k and any outside savings, IRAs, Roth IRAs, things like that. And you need to understand, okay, what portion of this am I going to use to get through the first 10 years of retirement? What portion am I going to use for the next 10 years and then the last 10 years? Because if you're seriously considering the lump sum, I think it's prudent to assume that you're going to live 30 years in retirement, you know, beyond life expectancy. When I do financial planning, I typically assume, you know, 92 to 94 as life expectancy instead of, you know, the book value, which is probably closer to 80, 84, 85.
Do we want to get into the most recent segment rates?
Yeah, I think that's a good idea. So as we talk about these, what you're probably going to think about is, you know, say your buddy that retired, when did they separate from service, and if they took the pension right away, whether it was the lump sum or an annuity, did they change the retirement date slightly based on these rates? And the current example that I would give on that is that we had a couple people that retired in the first part of this year, and they made the decision to move their retirement from April to March. And the reason for that is that the segment rates associated with a March retirement were on the front end 4.17 and 4.5 for the first segment, 4.76 and 4.96 for the second, and 5.25 and 5.4 for the third segment. If you waited just 30 days and retired, you know, a month later, the segment rates that you were working with were approximately 4.65, almost 0.5% higher on the front end, about 5.25, almost 0.5% higher on the second segment, and then 5.6, about 0.25% higher on the third segment. So as a rule of thumb that I use is that about 1% movement in all three segment rates would change the lump sum value by 9 to 10%. So this is an amount, this is about 0.5%, not quite 0.5% across the board. We're talking about 5%. So, I mean, if you have $1 million pension, that's $50,000
Yeah.
that you could get by retiring in, say, March versus April.
Mm-hmm.
So that is the most recent example of people maybe timing their retirement slightly to when it is most advantageous. The current rates, and this is kind of what we're thinking the update is going to be on a quarterly basis, the current rates, which are going to apply to a third quarter retirement, are 4.65 and 4.99. So what happened is in February of 2025, rates were a little bit lower, 4.65, but as the tariff conversation started to get going, people got a little bit concerned, and so the second half of that equation was 4.99. The way that this is calculated is they take, of the last 2 months of a quarter, they average the two segments to determine what the retirement discount rate is. So in this case, the second quarter moved us in the wrong direction. Interestingly, on the second segment, February of 25 was 5.38. The second segment, March, was 5.3. So what we had happen was short-term rates were going up, but more intermediate-term rates were staying mostly the same to slightly declining. And then the third segment rates came down. They went from 5.81 to 5.48. So what we have right now is this kind of flat yield curve where you're not there's just not a ton of movement. Rates kind of across the board are locked into that kind of 4 to 5.5% range. I think what a lot of, say you're close to retirement, what you're probably hoping for is that the Fed starts to cut interest rates, which will help on the first part of the curve. And then, if we start to see either that inflation is looking a little bit more arrested or the economy starts to slow down, that would probably be the indication for the second segment to come down.
Mm-hmm.
Because as we talked about on another podcast, the second segment, the Fed, Jerome Powell, doesn't really have a lot to do with it. If he's cutting rates aggressively on the short end, the second segment is probably coming down, but it's not directly tied to what he's doing.
Mm-hmm.
So I would say that right now, if we look at just the last couple of years, the current environment is neutral to slightly negative, to be honest. And so if you're thinking about retiring soon, I would be looking at these numbers and thinking, all right, if I could get this second segment back into, the mid fours, I would feel a little bit better about taking a lump sum.
I mean, given things move in the other direction, I guess that's something you're always weighing that, no one can see the future and what's going to happen. And so if, say, someone comes to you and they want to retire in the next year, at what point would you say, I think this might, without being able to see the future, I think this might be a fair enough time? Those seems like very difficult decisions to make.
Yeah, it's going to be personal because it's going to depend on how much wiggle room does your plan have. Do we need this, to be a perfect execution for everything to work out, or, do we have maybe a couple extra years of income, or we just know that your asset base is pretty substantial compared to your income need as we go forward? That's a factor. But one thing I would say in cautioning and getting too tied up to what's happening in interest rates is if you're going to take a lump sum, you have to also think about what am I going to do with this money on the other side? Because if interest rates are really low and you get a huge lump sum, what that means is that safe investments outside of the pension plan aren't going to yield anything. Mm-hmm. So what we had in, say, 2019, 2020 was, okay, you took a lump sum, you feel great about the timing, and then you go into a bond market where the 10-year U.S. Treasury is trading at like 1.75. So you're basically just getting eaten up if inflation starts to come back. And also there's the impact of duration. So interest rates start to go higher. If you own bonds of any length, you're going to lose some principal value as that happens. So it's not all about getting the perfect lump sum institution or execution. It's also about what am I going to do with the money after? And say the second segment goes up to 7. What that means is that you're going to be able to get really safe, good quality bonds that are paying a whole lot more than they are today, which means, all right, I'm getting less of a lump sum, but I feel pretty good about what I'm going to be able to invest that lump sum in.
Awesome. And is there anything else you want to cover or that our clients should know, our prospective clients, people thinking about retiring from ExxonMobil in the next year or so before we wrap up this first rate segment?
Yeah, I would say that it's probably not going to be perfect because, like I just said, if you get a great execution on the lump sum, it might be harder to find something good to invest it in. If rates are moving up and you feel like you're losing money in the lump sum, it probably just means that you're going to find some good stuff on the outside. So this isn't going to be perfect, but be thoughtful and look at, all right, when do I need money? When is, one of the things we talk about is that risk in retirement is really amplified if something negative happens early. And so if you take your lump sum and you invest it really aggressively and the market goes down a whole lot, that would be one of those scenarios where you can really do some damage to yourself. So make sure that you have a good plan for the lump sum proceeds, regardless of who you're working with, and that you're not taking too much risk with that.
Awesome. Well, as always, to everyone listening, thank you so much. To our clients who have recently tuned in, we're really glad you're here. If you have any other topics or questions that you'd like for us to cover on the podcast, you can send us an email at tpfp@rwbaird.com. You can also follow and subscribe on YouTube, Spotify, and Apple Podcasts. Thank you for listening to another episode of The Personal Finance Project. This show would not exist without the help of our brilliant creative director, Kira Minifield. Kira, thank you for everything you do to keep this show running. On to the disclosures. This broadcast contains the current opinions of the hosts and are subject to change. The broadcast is provided for informational purposes only and should not be considered investment advice or recommendations. Investors should obtain professional advice before making investment decisions. This is not a complete analysis of every material fact regarding any company, industry, or security. The information has been obtained from sources we consider to be reliable but cannot guarantee their accuracy. Robert W. Baird & Co. Incorporated is not a legal or tax services provider, and you are strongly encouraged to seek the advice of the appropriate professional advisors before taking any action. For more information about any companies discussed, please contact Baird. Past performance is not indicative of future results, and diversification does not ensure a profit or protect against loss. All investments carry some level of risk, including loss of principal. An investment cannot be made directly in an index. Investors should consider the investment objectives, risks, charges, and expenses of a fund carefully before investing. This and other information is found in the prospectus and summary prospectus. For a prospectus, please contact your financial professional and read it carefully before investing. Annuities carry unique risks, including market risk, investment risk, and claims-paying abilities of the insurer. There may also be instances where a contract will pay out less than the premiums paid or expire within the lifetime of the insured. There may be penalties for early withdrawal, and they are not insured by the FDIC because they are insurance, not an investment. Investors should consider carefully information contained in the prospectus or, if available, the summary prospectus, including investment objectives, risks, charges, and expenses. You can request a prospectus by reaching out to your financial advisor. Please read the prospectus carefully before investing. Investment returns will fluctuate and are subject to market volatility, so that an investor's shares, when redeemed or sold, may be worth more or less than their original cost. Unlike mutual funds, shares of ETFs are not individually redeemable directly with the ETF. Shares of ETFs are bought and sold at market price, which may be higher or lower than the net asset value, NAV. Baird does not issue or underwrite mortgages and does not service mortgage lending services. Any references to mortgages in the financial services offerings are purely intended to convey an engagement in this holistic planning process, with this as one piece of the larger picture, which may or may not apply to all clients. This broadcast may not be reproduced without express permission of Robert W. Baird & Co., Incorporated.